Aloha Friday, everybody. Skyler here with you as always. And unfortunately, Chad is enjoying himself in on the slopes of beautiful Big Bear. We're up there. But really excited today. I have the newest member to the Aloha Ohana, Mr. Chase Mason, CFP, and just mega foodie. What's up, buddy? How's it going?
Good. How's everyone doing today? Yeah, Chase Mason here, newest member of the Aloha family, the Aloha Ohana. So yeah, CFP, foodie as you say, and fellow surfer.
Yeah, dude. I like that board in the background. That's pretty sweet. Tell us about that
Yeah,
board.
it's a cool rock and fig longboard that my brother scored on Craigslist, and then he just decided to have it kind of as decoration here at this house. So kind of cool. Yeah, it
Is it
just kind
is
of
it
fits well
balsa?
there. No, I think that's just like a laminate or something like
Yeah,
that. But
yeah,
I mean, it looks rad.
yeah. That's sweet, man. Dude,
Yeah, it's cool.
so tell us a little bit about your story. Like where did you come from? Where do you hail from? What's the deal, bro? Like give us the
Yeah,
scoop.
where I came from and how I got here today
Yeah,
at
yeah,
Aloha for sure.
yeah, yeah.
So my name's Chase. I grew up in Huntington Beach, California. Still live here currently. So I just kind of have been hanging around this part of the world my whole life. Went to school in Utah, and that's where I kind of actually discovered this industry. So I got my bachelor's in financial planning. That was the degree. And doing that, I knocked out the education requirement for the CFP exam and sat for that. Actually, a month before I graduated college, I passed that exam, which was just the best thing that's in my career probably so far. It was one of the biggest, stepping stones and kind of solidified me being in this industry. And then, so yeah, I feel like I've been working in the industry for a long time now because all my schooling years, all 3 years, I was actually working towards that major. I was just surrounded by industry terms, knowledge, planning strategies, and things like that. And then, yeah, I just worked here at a firm in Huntington for a couple of years, and then you and I connected on social media, and we've just been kind of building our friendship relationship ever since. And then after multiple, conversations, this, we just decided, I think it makes the most sense for us to actually team up and do this thing together because, our goals were definitely in alignment, and we both kind of had the same vision of what we wanted not only our own practices to look like, but also the industry to look like in the next 5, 10, 15, 20 years.
Cool.
So
Yeah, dude.
yeah, I mean, that's kind of it in a nutshell, I guess.
Yeah, I love it. You just spoke to my heart, bro. Like it, oh man. That's exactly what, just as you said. Dude, it's so funny. I remember you reached out to me on like I think it was Instagram and
It was. I
and
could probably pull up the DM right
I was
now.
like, who is this guy? What is what's going on here? He's like 401k, 401k tips, and I was like, what is this? And then and I was like, I don't know, like maybe this is like some sort of scammer or something. So I totally deleted the message. I was like, oh no, like whatever. And you hit me up again. You're like, dude, what's up? Like I like want to chat with you. I was like, oh, okay, cool. And then we just started hanging out and
Yeah,
talking and stuff. And next thing you know, here we are, dude. So super
totally.
fun,
I just
man.
remember finding your page and I was like, it was evident that you were local, Orange County or San Diego or somewhere like that. And you were doing basically exactly what I wanted to be doing. And I
Mhm.
was like, I need to message this guy and at least just start having some conversations because I know it's going to be beneficial for me. And then, yeah, that fast forward like 12 months, here we are. So
Yeah, dude,
very
so
cool.
excited. Well, welcome, man.
I
And como
know.
mai. Like I'm so pumped for you to be a part of the team. And just so everybody knows, the CFP is a series of courses that dives into every uh, specific financial planning for individuals and very, very uh, broad knowledge, but very specific knowledge on all things financial related for individuals and some stuff on business owners and things like that. So it's a very, very hard thing to pass. I think like the pass rate is pretty, what is it, like 60% or something for the first time or something like that?
Yeah, I think it was like 40 or 60%, somewhere in
Oh
that window.
man, yeah. It's so you just your level is right way up here, bro. Like you're ready to
Oh,
rock and roll, man. Especially with
oh
that board in
man.
the
Well,
background.
Oh, there you go. Yeah, we're ready to cruise, right?
Yeah. So
Yeah,
it's
I
cruise.
guess yeah, doing that whole thing, because passing or going through the coursework took a long time in and of itself. That was the majority of my college degree was doing that. And but then studying for the exam in and of itself is also another animal completely on its own. So those two things together, it actually grew my love for the industry and what I wanted to be doing. But it is crazy the stuff they did to my brain, and the stuff you have to go
That
through
makes so much
to
sense.
pivot. Yeah, exactly. So yeah, I'm really glad that I got that out of the way, and that I can use that designation now.
Yeah, that's awesome, man. Well, again, welcome. Really excited, dude.
Thanks.
Yeah, it's going to be an awesome partnership here moving forward. So I think, I think this week has really kind of um, been an eye opener for a lot of people as far as the markets are concerned, and I feel like it's a pretty interesting market in and of itself right now,
Hmm.
with interest rates going up and the volatility in the major indices. Um, the Federal Reserve saying that they're with basically like they see short-term inflation, but also um, there could be some. They're going to keep rates low for at least till 2023. So I think if we want to talk about that for just a couple of seconds or a couple of minutes,
Yeah.
I, give us a thought on um, or your thoughts rather on how things are playing out right now, and where you see the market going in the next, say, 6 to 12 months.
Well, I mean, looking at the past, I guess, week or two, interest rates are increasing. That's a fact, right? And it's crazy because that's kind of what my focus is right now, at least, is interest rates. Because there are a lot of U.S. investors that are, their portfolios, especially retirees, are heavily weighted in bonds. And it's just really important to understand the inverse relationship between bond prices and interest rates. If the interest rates are on the rise, that means, bond values are going to drop. And so if you're holding bond funds or things like that, it might be time to kind of look at your position and assess your risk, I guess you could say, because the 10-year Treasury bond, which really is kind of a benchmark or an indicator for a lot of things across the country, that's increased. That's a fact. And the Federal Reserve kind of made a statement basically saying we're just going to let it see what happens. So we're basically looking at 2%, like staring it in the face, which is kind of intimidating because interest rates have been on the way down since the mid 80s. They've just been trending downward and downward and downward since the mid 80s. So naturally, if you look at that graph, I mean, where are they going to go now? Can they keep going lower? I mean, if they were to, they're going to go negative. What's going on here? So now, as we see some increases here and there, it's kind of caused some panic, I guess, for a lot of bondholders, because if they start trending upwards, their positions could be at risk, I guess.
Yeah, that's a good point, and I think it's important to kind of highlight how that works. So like, if someone has a bond and it's paying 1%, like let's call it 10-year, right? Someone buys like a 10-year bond at 1%, and the interest rate goes up to 1.75%. You want that 1.75% because you're going to get more for your money, right?
Mm-hmm.
You have to sell your dollar bond or your 1% bond at a discount in order for you to get that 1.75% bond. So in order for that to happen, you basically take a cut. And what that does, just like you said, it's a risk for your bond portfolio, just your portfolio in general, your fixed income assets. So I think, yeah, I think that's a really good kind of point to make, is if people end up having, or if let's just say, the 10-year just keeps going higher and other interest rates, or not interest rates, but bond yields continue to go up, we have to really kind of look at, an overall portfolio, and assess whether or not it makes sense to have bonds inside that portfolio. Because like you said, if the Federal Reserve wants to continue to push rates higher because that means that the economy is doing well. But if they keep things low, over the long term, like it may or may not be beneficial. And I mean, they've got a black book of all kinds of crazy things that they can, look at and dive into and research and analyze, stuff like that. But it's so from that perspective, I think that there's a lot of alternatives that are out there that could potentially be a good replacement, or at least replace some of that bond risk, right? As an example, I mean, we've talked about before, like market linked CDs. Those are a great thing to potentially have in a portfolio, or buffered notes, things that pay monthly or quarterly coupons, or things like that are tied to an index. Like there's all sorts of really cool opportunities out there when it comes to other investments besides just the bond fund or just a straight bond. So it's a good time to reassess your portfolio.
For sure. And I like what you said with that example, of looking at the bonds and the discount and everything. And even to just put it more simple, because I just, that's the way I like things.
Yeah.
Even if you were just to look at the value of a bond fund, like the BND fund or something like that. I mean, if interest rates are going up, the value of that is going down, plain and simple, right? If interest rates are going down, the value of that bond fund is going up. So it's just looking at your portfolio, it could cause some volatility that is pretty unexpected because, like I said, since the mid 80s, interest rates are trending down, which means the value of those bond funds are going up. It's just kind of been known as like the steady Eddie way to go, just something that you can put in your portfolio to add some stability and things like that. Having volatility in bonds is, I guess I could say, unfamiliar to a lot of people, because for a couple of decades, that's just not been the case, So I'm really interested to see what the next couple of months hold and what's going to happen with, the 10-year treasury bond. That's really going to determine a lot of it. And I mean, we'll see. It's definitely a very interesting thought that, a lot of people probably haven't seen anything like this for a while. So.
Right. Yeah. And to that point too, the amount of trades that happen in bonds, or let's just say the volume of bond trading, is twice that of the stock trades, right? So there's a lot more weighing on bonds than I think people realize. Everyone sees the stock market and they're like, oh, like, the NASDAQ is up, 30% since the beginning of the year or whatever. Well, the 10-year treasury is up like 60%, and no one really talks about that as far as, part of their portfolio. So it's just,
totally,
everything is related. We just have to I think the school of thought in financial planning is, over the long term, just diversify, figure out a way in which we can take advantage of certain markets and certain asset classes, and diversify so that you don't have as much risk associated with ups and downs and
definitely. And I mean, there's so many alternatives to bonds that are out there. I can just name 5 off the top of my head right now, but it's true. Like I feel like the social norm or the culture of the United States has just been, if you want stability in your portfolio, go get some bond funds.
Right.
It's that simple, right? And it has been that simple, and it's worked for a long time. After 2020, we'll see what's coming out the other end of that. And this might be some of the first signs of some of the more long-term effects that might have had on, I don't know, our economy, I guess.
Right. And, this is actually a really good way to kind of transition into the next thought, which is, I've had some people, which is really interesting, in the last couple of weeks, talk to me about using some of their portfolio that provide dividends as income in retirement. And I wanted to get, your take on what you think of, or what comes to mind when you think of dividend income in an interest rate environment, in a market environment, in an economic environment that we're in right now. What do you think?
Yeah, very good question. And it's kind of becoming, I don't know if I want to say a trend, but I have heard of this a lot more, of people just strictly using dividend income to supplement their retirement outside of, Social Security or pensions or whatever else they have going on. And my first thought, and this, is sketchy. That's my first thought, just that word.
Yes,
like
I love
sketchy.
Like,
Can it work? Sure.
Maybe,
A
yeah.
lot of things can work. Are there a handful of risks? Yeah, there are. I think that it's definitely a great starting place for a lot of people. However, there are there's risks involved, right? And the first and foremost that I can think of is concentration. The bulk of your portfolio, if you want good dividends for retirement income, would be concentrated in large cap stock, right? I guess I've talked to so many retirees throughout my career, and the majority of them don't really like holding a lot of stock in their portfolio. They like to be diversified. And that's just a core principle of investing for long-term successful investing is diversification. I think if anyone's watching this call, they would probably know that, but I got to say, a lot of people are comfortable holding stocks, especially single stocks in their portfolio. But like, if it's going to be 80% of your portfolio is single stocks that are producing dividends, that's highly concentrated in that single asset class. And you're going to be ignoring or missing out on a bunch of other asset classes and opportunities as, markets cycle throughout time. So that's kind of one of my first thoughts. And then another is there's no guarantees, right? There's just no guarantees. That's a fact. Interest rates can be cut. Does that mean that they're going to be cut? No, that doesn't mean that they're going to be cut, but they can. Dividends are made up of earnings on the company, right? And so if the company doesn't have earnings, no dividend, that's just not possible. And no company really wants to cut their dividends because it shows that they're in a tricky spot, or they might be showing some weakness. So they don't want to do that. But, it's not a perfect world. They're not going to be crushing it every year. And as we saw in 2020, a bunch of companies had to cut their dividends. And in 2020, I mean, the excuse for anything and everything was, because of COVID. I'm sure everyone's heard those words so many times. Oh, sorry, bathroom's not open. Why is that? Because of COVID. Oh, we don't, like anywhere you go. Oh, yeah, we don't do free refills anymore because of COVID. And it's just like everything's because of COVID. It's kind of this blanket statement that like we can kind of get away with doing stuff we didn't want to do before, even though maybe if it didn't have anything to do with actually keeping people safe, they would just kind of do that. And cutting dividends, that there's they have their reasons, but because of COVID, people might let that slide. I don't know, but what I'm saying is, there's no guarantees. Somewhat sketchy if the majority of your retirement income is from dividends. If dividends are cut, your retirement income's cut, and you don't see that coming. That just happens. You don't make any of those decisions. So those are my first thoughts. But let's see what you got to say.
I want to jump in. So I have two things to say. Number one is there's no free refills because of COVID, and the bathrooms are closed because of COVID. It makes me think how many times you went and got food somewhere because you're just a total foodie.
I am a foodie, man. I'm out there all the time.
Oh my god. Those
are my two first thoughts, right?
Yeah, exactly.
Totally.
The second thing is we've been in a tax environment or tax rate environment that's been really, really beneficial for corporations. And as who knows what the tax code is going to look like in a year, 2 year, 5 years, whatever. But if you're planning on generating income from dividends, if tax rates go up and some of these companies have to pay more in taxes, they're not getting as much in revenue because of COVID. What might that do to, the overall dividend strategy that they have for their investors, right? Like they could potentially be either dropping it, cutting it, whatever. So that's another risk too. And I just wanted to throw that in there because I think it's been on the minds of a lot of people. Taxes are, a necessary evil, I'd say, for the benefit of everybody. But it is something to be considering when looking into generating income from your portfolio moving forward. The last thing I'd want to see is for someone to have, $1 million in one particular stock earning 30, 40 grand a year in dividends. And then the company has they have to pay more in corporate taxes. Plus, if we also take in the account of the, potential $15 minimum wage hike, that could potentially have some economic effects to businesses and companies. So from an overall perspective, it's just to your point, and just sound investment strategy of diversifying your income from where you're getting it from, not just off of the dividend, I guess a dividend portfolio, so to speak. Of course, like that you should have at least, or think about having that inside of your financial plan moving forward, which is there's just risk associated with it, and it's sometimes a good idea to reassess where you are, reassess the current economic, political climate, and then make changes as things move forward, not just expect to always be in the same position and always have that dividend income moving forward.
Yeah. And you brought up a really good point. Increasing taxes, I can totally see that happening going forward. That's just the way things work. Nothing wrong with it. It's just how it works, right? And if you're increasing taxes on corporations and big businesses, dividend paying stock businesses, right? You're basically increasing their expenses, which means less earnings, which means less dividends. So that's kind of a domino effect that is a total possibility. Is it going to happen? Who knows? But it's a total possibility. I mean, when building out a comprehensive financial plan, you have to weigh all of that and put that all in there, right? And another thing is, I also really believe in diversification across the board. Diversification in your taxes, diversification in your investments and savings, and then also diversification in your sources of income for retirement. Pension, Social Security, those are two that are very popular. Pension's probably going to be going away here in the next 30 years. We probably won't see very many more of those, right? But amongst your savings, you can diversify the income to be from multiple sources. And that's, if you believe in diversification, why wouldn't that be a good idea? Because you just can't count on all of it coming from one source, especially if it's your personal savings. Company pension, if that's the majority of your retirement income, that's a different story. That's completely different. But if you have your nest egg of savings and you're using strictly dividend stocks, or the majority of it being in dividend stocks, you have to weigh all the risks that we just discussed. And it might work for a decade or two for some people, and for some people it might not work for even a couple of years. It just depends on what the future holds, right? So it definitely has its benefits, and then there's also its risks. So using it for a portion of your income, if you're comfortable with the risks and whatnot, it's not the worst strategy, But if it's the majority, if you're getting the majority of your retirement income from any single source, you might want to look at your risks, because there's risks with everything.
Right. And I would also kind of add in there for Chad here, because he's our real estate guru. Always look into real estate also as a potential way to generate some income in retirement, especially down here in Southern California.
Absolutely.
It's crazy. He was on or we were talking last week, or maybe the week before, and he was saying that there's been so many instances where his sellers have gotten $100,000 plus over asking from what the seller originally wanted, because it's just such a ridiculously hot market right now. So those sellers, they've got potentially some money to either invest or use as income, moving forward. But man, it's crazy out there right now as far as real estate. So, but that's another potential way to generate income, in retirement.
One of the things I'm thinking of right now is, let's say you went to a financial planner. Let's say someone came to us, right? We have a CFP, an AIF, CIPA certification, all that stuff. We have all these designations behind our names, and we've been working in the industry for a while, and they came to us and they paid us to put together a financial plan, a retirement income plan for them. And we came back and said, hey, you should just all be in one asset class for your retirement income. I just feel like, how dumb will we look? You know what I mean? You should never tell them to put all their eggs in one basket. But like I said, it is a great starting place for the majority of people. It's a great starting place, but there's always room for improvement. And I firmly believe in diversification across the board in all things.
High five, bro. That's two of us.
Yeah, let's do it.
Yeah. Cool, dude. Well, let's wrap it up here. I'm again, man, I'm so excited to have your amazing knowledge and appetite with us here at Aloha, man. I'm so pumped. Yeah, dude, let's make this happen.
Yeah, I'm
And
looking
thanks.
forward to it, Skyler. I think we're going to do a lot of good work for a lot of people here in the next couple of years, and I think we're really going to make a lot of good changes for the better.
I agree, man. Cool. Well, Chase, thanks, buddy. We'll maybe next week we'll do something else.
Yeah,
Another Aloha Fridays and share some new thoughts on either the markets or bonds or something else. So there you go.
perfect. Sounds good.
All right, Chase. Aloha Friday,
Later,
everybody.
man. You
Cheers.
got it.